Now this is a complicated topic, so we're going to be trying to do this in a series of stages here today, exploring different aspects of the topic as we go along. We're first going to start with a simple description of how the corporate income tax works today, and then lay out what we see as being its most basic flaws. Then we'll look at some of the other proposals that have been put forward to try to reform the system, and show that while some of them have some merit, they really aren't enough to fix the underlying problems that we've identified. So then we'll turn to the proposal that you and I worked so hard on, set forth some of its provisions, and then describe why we think it does fix those flaws and the economic benefits that it will bring to the United States. And then try to say a few words about what the prospects might be for Congress and the President to actually do something, both in the short run and in the long run. So I guess we should start by just explaining how the corporate income tax works today.
Okay, thank you, Alan. It's been a great pleasure for me to work on this project. I've learned a lot. And I think it's very important that the public understand what the problems are. It's one of the biggest issues in our tax system now, and one of the least well understood. So we'll give it a go. So I'll first start by talking about what the corporate tax is. Corporate income tax is the third largest revenue source in our federal tax system. It raises a little over 10% of federal revenues, about 2% of gross domestic product. And it is a tax on the profits of corporations, as you could imagine. Profits are just simply, you get your revenues from all your sales and you deduct your costs. And the difference is your profit. Now the costs include things like wages you pay to your employees, purchases from other firms, interest that you pay to your creditors, and the cost of your equipment, which you get to write off over time. You will discuss that a little further, but you get to deduct over time the cost of the equipment and buildings you buy as they wear out. The one thing that is not deductible from your revenues is the payments you make to your shareholders, to your owners, the dividends you pay to your shareholders. That the shareholders pay tax. And for all these other sources of income, the wages you pay for the workers, the tax is paid by the workers under the individual income tax. Your creditors pay tax on their interest under the individual income tax. And your shareholders pay tax on their dividends under the individual income tax. So what you have is what's called the double taxation of corporate dividends. The revenue is taxed first at the corporate level, and then it's taxed again when it's paid out to shareholders as dividends.
And the capital gains are double taxed too, really.
That's correct. Although they get to be deferred until the gains are realized, something we will talk about a little bit later.
Yeah.
So this is the basic structure of the corporate tax. The top rate on corporate income is a graduated rate. The top rate is 35%. Most corporate income comes from large corporations, and most of it is paid at the top rate of a federal rate of 35%. The states also tax corporate profits, and their rates average to a little over 6%. So when you take into account the interaction of the two, the average rate is about 39% on corporate profits. However, corporations don't actually pay 39% on their profits because of certain tax preferences. And Alan, your turn to talk about that.
Sure, yeah. So the corporate income tax does have a lot of provisions in there that offer companies a way to reduce their taxes. For example, there's special credits for different types of activities, such as research and development expenditures that the company may make, and preferences for certain types of energy. Also, Eric, you mentioned the depreciation that can be claimed on equipment and structures and other things the business uses, how you write those off over time as they wear out. But in fact, the preference in the tax code is that you can write a lot of those off faster than they actually wear out. And so that accelerated depreciation is another tax preference that allows companies to reduce their tax liabilities. Now, those preferences are all available to corporations that pay the corporate income tax, but they're also actually available to other businesses that don't pay the corporate income tax, the pass-through businesses. So maybe you could talk
about
And maybe I
should interject a little bit about the pass-through businesses, because most businesses in the United States are not, over 90%, are not organized as taxable corporations. They're taxed as so-called pass-throughs, which means instead of the profits being taxed to the business, the profits are allocated to the shareholders, the owners, the partners in proportion to their ownership, and they pay individual income tax on that income. Pass-throughs account for about 40% of revenues of U.S. businesses and about 60% of net profits. So pass-throughs are very important, and they've become increasingly important. Now, what are pass-throughs? People own their own businesses. They pay tax as an individual. People form partnerships with other people. And there are what are called subchapter S corporations under a certain subchapter S of the Internal Revenue Code. And these corporations are allowed to be taxed, if they meet certain tests, are allowed to be taxed as pass-throughs as well. So they do not pay the corporate income tax. Now, when you look at the treatment of pass-throughs, the benefit they have is they do not have to pay two levels of tax. The payment of distribution of profits has no tax consequences. All the profits are taxed once, whether they're distributed or retained in the business.
So that's, I think, an overview of how the corporate income tax and the taxation of pass-through businesses works. There is
I did want to add one thing there also, that the advantage of being a corporation used to be that you had limited liability. That is, the owners of the corporation were not liable for anything beyond their investment in the corporation. And that was not true for pass-throughs. However, now we have more and more forms of pass-throughs. The S corporations are one type, what's called limited liability partnerships are another type, where there is the same feature of limited liability for the owners as for the owners of corporate shares. So that's meant the advantage of being organized as a corporation is much less than it used to be.
It really does raise a question of why corporations are being singled out for that double taxation. Maybe you should say a word, Eric, about how the corporate income tax works in the open economy, because that's important to why we decided to pursue this reform.
Right, and so this is a increasing feature of the world economy. It's become more globalized. U.S. businesses have become more globalized, and businesses that have started in other countries have become more important in the global economy. So we have a situation today in which most of the largest corporations are global and multinational. And what does that mean? It means their workers, their employees, their production is carried out in locations all over the world. They source certain components in Brazil, certain components in France, certain components in the United States, certain components in China, everywhere. The second feature of globalization is sales. They sell in markets throughout the world, and foreign markets have become increasingly important to U.S. corporations. The third feature that's really important is shareholders. Now you can buy shares in foreign corporations as well as U.S. corporations, and U.S. corporations are marketing their shares to foreign investors. So the investors come from all over the world. And even the R&D, even the headquarters functions, even central management is becoming more decentralized. So in what sense is a company a U.S. company, other than historically they started in the U.S.? Well, the way we define a U.S. corporation is a company that has a charter in the U.S. It has been incorporated formally. It has a piece of paper that says it's a U.S. company. That's all what that means. But these multinational groups are organized into separate corporations in all these different countries. So the charter is really where the parent corporation, the one that's the head of the whole multinational group, is so-called resident. U.S. is probably one of the only remaining large countries which taxes its resident corporations on its worldwide income. However, that's a very gross simplification for two reasons. One, if a U.S. company's affiliates in a foreign country pay foreign income tax to that government, the U.S. will give them a credit against U.S. tax liability for foreign income taxes paid. The second reason is the profits that they earn in foreign countries are not taxable as they're earned. This is a provision known as deferral. They get to defer profits. Any profits that are earned overseas that are reinvested get to be deferred until they are paid back to the U.S. in the form of a dividend. So that has a tremendous effect in reducing the tax on income in low tax foreign countries, way below the tax that's paid if those same profits were earned in the United States.
There is still a significant difference, though, between the U.S. chartered companies and the foreign chartered companies, in that the foreign chartered companies don't pay any U.S. tax at all on their overseas profits. Those are really just outside our jurisdiction.
That's correct.
But the U.S. chartered companies, they do pay some tax on their U.S. tax on their foreign profits, but they get those two key benefits that you mentioned, the credit for foreign income taxes and the deferral, which certainly ease that burden quite a bit.
The other feature of international tax rules that's worth mentioning is each country gets the first bite of income that's earned within their borders. So any corporate profits that are earned from activities in the United States, whether by a U.S. charter company or a foreign chartered company, is in theory paying U.S. corporate income tax. Similarly, any profits in France are paying French corporate income tax, regardless of whether it's a U.S. company, a British company, a Chinese company, or anything else. So the first bite comes from the source country where the profits take place. We'll get a little later, soon, to the issue of, well, where are those profits and how do you determine where they take place?